Hey guys, we're back with another live, and today we're going to be talking with Alec Johnson of Cross Country Mortgage about a unique topic, which is a DSCR loan, which is a way for people to be able to get into an investment property with using this type of loan. And obviously, we're going to go over the loan with Alec and be able to give a little bit more clarity with this loan for those out there that's maybe interested in it. And so, with that being said, welcome Alec to the
Yeah,
chat.
thanks for having me. Excited to chat with you today about this topic. It's something that is near and dear to my heart as being an investor myself and just loving real estate and just loving houses and trying to figure them all out of how you can be involved in it. So, yeah, it's a fun topic for sure.
And so, I know we kind of talked before, and we are part of a Tuesday, or I guess not Tuesday, but Thursday investment group. And so I know that you really have a heavy focus on investment properties type
Yeah.
loans. And so this one kind of stood out, and I'm like, okay, let's probably put this into the masses for all of those folks that don't really know about a loan like this. They can be able to take advantage of it.
Well, yeah, I mean, I think over the last few years, this type of loan has really grown a lot in popularity. Just because it's a simple way for more seasoned investors to really um, access, the funds they need to be able to purchase properties without kind of the maze of paperwork. So it's definitely a good spot to have for sure.
Yeah, no. So, Alice, let's dive into it. I think that a lot of people are wondering, like, what is a DSCR loan?
Yeah, it's sort of an acronym that is difficult to remember, but what it stands for is debt service coverage ratio. All that really means, and all it boils down to, is it's an analysis of the property itself, meaning does the proposed rent or the current rent that the property brings in, does it meet or exceed the mortgage payment that of the person that's going to purchase it? So that's in this type of loan, there really is no personal finance that's looked at. So we don't evaluate, if somebody has a normal W-2 job maybe and wants to invest in real estate on the side, then normally we would have to, it would be a maze of paperwork to figure out all their personal stuff. With a DSCR loan, all we're looking at is the cash flow of the property. So we don't care about their tax returns or their pay stubs or their W-2s or any of that. Even if they own multiple properties, all we're looking at is the subject property, the one they want to buy, and does it cash flow or does it at least break even? That's all we really care about. And so it makes it a lot simpler for either first-time investors or seasoned investors, especially seasoned investors. Say you own 8 to 10 rental properties. Well, number one, doing a conventional loan, you're going to start to run into limits where you can't have more than 10 rental properties or finance properties, I should say, with a conventional loan. But it really makes it a lot simpler so that you don't have to document, um, you know, pay stubs, and you don't have to document mortgage statements and all sorts of different things. It just makes the process a lot simpler and quicker.
And so, with that being said, for those that obviously you can take this process, and if you're not looking for pay W-2s and 1099s anymore, and it is
Yeah.
solely based on cash flow. So, this out of curiosity, what happens if it doesn't cash flow?
It's a great question. So, with the DSCR loan, there's sort of a ratio that we look at, and it's just basically does the rent that is going to come in meet or exceed the payment, and we're going to look at a total payment, not just the mortgage itself. We're looking at what we call PITI, so it's principal, interest, taxes, and insurance. So all those four things combined, and association dues if it's a townhome or a condo or something like that. But we're looking at that total mortgage payment, excluding utilities or anything else, and we need the rent that's going to come in to meet or exceed that. And that ratio would be, if it meets it exactly, it's a 1.0 DSCR. For us, we're just looking for most of the loan structures that we want. We just want it to be a 1.0 or higher. If it's less than that, like it's gonna be a loss, but there's a reason why maybe the investor wants it, either for tax reasons or for investment reasons. They really think maybe the neighborhood is an up and coming area and they just want to invest there, even if it's not going to cash flow today. We can still do it, but it changes the narrative a bit on how much they have to put down and some of the terms maybe. So there's still ways to do it, but basically what we're looking for is we want the rent to be 100% of the mortgage payment is kind of the easy way to look at it.
Right. And I think for most cases, it should definitely be at least a mortgage payment.
Yeah.
I know you just want to have it.
For, like you said, for most cases it would, and for most investors, they probably won't want to invest if it's not going to at least cover itself.
Right.
But with rates where they've been for the last few years and some other variables with the housing market, it's not always easy to do that. So it's not like any property you look at is just by default going to cash flow. That's not really the case. You have to be, as an investor, you have to really evaluate it in a very strategic manner and make sure that your numbers are accurate and what you think you can get for rent is an actual good target. So there's a little bit more to it, but yeah, I agree. I think making sure that it's at least going to cover itself is a good place to start from.
Absolutely. And so, the biggest question for a lot of people is, why would they want to use a product like this?
Yeah, I mean, I think going back to what I mentioned earlier, I think it's just it's ease, right? It's if you have maybe a fairly complicated personal financial situation, or even in your other investment real estate, maybe if there's somebody that owns multiple properties, some of them could be commercial, some of them could be complicated. When you want to apply for a new loan to purchase a new property, it can be exhausting to kind of go through all that paperwork. And so it's a loan product that is tailored for investors that want to keep things simple. And that's really what it boils down to, is we just want to make sure it's covering the rent and the mortgage payment. And that's it. We don't get into the other stuff. And it just makes it where the burden of the process is just sort of taken away. I mean, not completely, but for the most part. And then it just makes the actual acquisition process and the experience of owning the real estate just that much simpler and easier. And they can actually focus on, the properties themselves and acquiring them or repairing them or, getting tenants in, and not, I need, 8 mortgage statements. I need 8 tax statements. I need 8 insurance statements. It can be a lot.
Right. So it just kind of streamlines the whole process, basically. So it just, you don't have to sit there and empty out every piece of paper you have in your portfolio. So okay. So
Definitely.
So just thinking about it, if y'all guys have you taken away all of that as far as all the paperwork is concerned, then what are the basic requirements?
Yeah, I mean, essentially for an applicant that wants to buy one in general, we obviously need a credit score. So it's still there's still some personal finance in that, in the sense that we need to show clean payment history, and we need to show an acceptable credit score and all those things. But there's actually fairly flexible credit qualifying for it. I mean, we can do credit scores down to a 620 with this program. It's not a one size fits all. There's going to be different rates and different down payments if you have different credit scores that are in the lower category. But that's nice, the flexibility that offers. But yeah, we need a credit report. We need to evaluate the property's rent. So that could either be, if it's currently rented and currently occupied under a lease, then we need that copy of that current lease. Typically, we'll get an appraisal on the home, which not only shows valuation. So say you're buying a $400,000 property, we need to show it's worth 400, but we also get what's called a comparable rent schedule with it that shows what is the market rent. And the appraiser will actually do a case study on what are other properties in the immediate area renting for. and then adjusting the subject property to sort of meet that, and then they'll come up with a market rent figure that we use as well.
Mhm.
And then basically we just need to show that they have enough down payment. So wherever the down payment's coming from, we can do on this program, we can do as little as 15% down. Now, I don't generally recommend that because the interest rates are not great at 15% down. They really improve once you're at 20% down or more, which is,
So,
pretty typical.
Alec, hold on 1 second. So
Yeah.
you said, is these loans for 30 years?
They can be shorter, but the standard one I would say is 30 years. Yeah.
Okay, I just wanted to make sure that we at least know the long term,
Yep.
if it's going to be years or not. And then I'm assuming that the interest rate is going to be pretty comparable to if you was to do this regularly.
Well, so there's a number of options that people have in general, but also investors will have as far as purchasing a new investment property. If you were to do a standard conventional loan, you're probably going to see with a DSCR loan, you're going to see a marginally higher rate than that. Don't quote me on this, but maybe 0.25% to 0.5% or so. So it's not a real big increase, depending on
Right.
credit scores and things like that. But with a conventional loan, you're going to have all those standard requirements we talked about, where it's not as simple to get done. But if it's somebody where they maybe only own a primary residence, and either this is their first rental property, maybe they only have one, then it's not such a big deal to qualify and get all the paperwork done. So maybe that would be a better fit. But
Mhm.
generally, these ones are going to be where it's just somebody that wants it to be, simple and easy, not getting too crazy, and 0.25% to 0.5% is not really going to make that big of a difference because
No.
they're going to be able to make more money acquiring properties and repairing properties and doing all those things, not so much figuring out the different loan stuff.
Right. No, and I guess I was just more so asking that question because sometimes, we comparing loan products, if this was like a point or 2 points higher, then it changes things.
No, it's usually just incrementally higher. Yeah.
Gotcha. And so, we starting to see a big boom in like the Airbnb communities, where
Yeah,
people
for
buy
sure.
properties for Airbnb purposes. Can you do this with this type of loan?
You can. There's some different requirements or restrictions to it. We still do a comparable rent schedule. Can be a long-term schedule, or there's ways we can use a service called AirDNA, which if anybody's um, in that space, they're familiar with that. It's basically a service where you can see what other people are renting their Airbnbs for. But yeah, you definitely can, and it's that's still a very popular type of investment property to do. I mean, you don't have to do it that way, but a lot of times people still want to do the short-term rent thing if because they can get a little bit more in cash flow in exchange, obviously, for more turnover, more effort. But a lot of times that's still very popular topic. Yeah.
And so, when you're looking at this as one option, what are some other options that investors have that they can possibly use, or anybody that's obviously looking to get into the rental property game?
Yeah, I mean, I think that the two main ones that generally people use would either be a conventional loan, with 20% down or more, 25 sometimes on it, if they're either purchasing their first rental property or maybe they only have a few. The requirements are much stiffer and there's more paperwork involved. This is a very popular one though for people that don't want to do that. And I would say those are really the two big ones. There's other ways that people can acquire properties, either with, if they're a self-employed business, we can use bank statements instead of personal financials to qualify. So if somebody has tax returns or a self-employed business, but maybe it would be easier to show bank statements versus tax returns because they're not done yet or they're complicated. There's ways we can use that to qualify. We can use CPA prepared profit and loss statements. There's a variety of ways we can qualify for somebody outside of this DSCR loan. So there's a lot of different ways nowadays that we can get people qualified to buy properties. And I love it because it makes everything so much more creative and flexible. Whereas, I've been in the business for, gosh, 22 years now. And for the longest time, it was, at the beginning of my career, for the first maybe 5 or 10 years, it was the Wild West, right? It was back in the, between 2004 and 2008. I mean, it was kind of craziness, as a lot of people know. From 2008 to, like, I don't know, maybe 5 or 10 years ago, everything was cookie cutter. I mean, it was like standard stuff, standard conventionals or FHAs. I mean, there really wasn't a lot of creativity in our industry.
Hmm.
But over the last, maybe, especially, I would say, 5 years, the creativity has really kind of come out of how we can get people approved and financed for others, with maybe alternative styles. Now, they're not the products from, the pre 2008 stuff that people are maybe concerned about, where we had, you didn't have to qualify for anything. These are all, there's one aspect of it that maybe is made more flexible, but the rest are still the full requirements, meaning credit score. We still have to evaluate all that. You still have to show and prove that you have enough down payment. It's not 100%, loan like some of those could be. So it's still a very safe and predictable loan product in that way, but it helps to just make things simpler and more accessible for people, which I really like.
So I know you spoke on down payment, and
Yep.
for those that's living in the current house, I know we talked about maybe the investor that's only looking to get more investments, but what happens with the person that's living in, like, they may have a house for maybe 10 years, got some decent amount of equity in their house, and let's just say, they don't have the down payment. What is some other options?
Yeah, it's a great question because it's something that I've done personally, but it's also something that a lot of investors, especially first-time investors, do. And it's basically where they can access their current equity in their current home via either a new loan, like a new cash out refinance. Potentially they can do home equity lines of credit. We have a couple of products that are actually AI driven, which I really like, that makes it super simple, and then people can actually close electronically. It takes, like, as little as 5 days. It's crazy. Those are really nice to be able to access quick money. But there's a lot of ways that people can access the current equity they have and then use that to sort of leverage their investments and build a new, bigger portfolio, rather than just letting all that equity sit there. I mean, obviously, the safer way, but it's hard to really grow equity when it's just sitting in your primary residence. So as long as people feel financially comfortable with it, there's a lot of great options where they can access that equity and then use it to either acquire new properties and use it as a down payment. One of the ways I've done it is both, I'll use the equity that I have, or a home equity line of credit, potentially to purchase a property in cash, because a property that, especially in the investment world, they might have, they might be fixer uppers. They might have a lot of things going wrong with them. And there might, the traditional loan programs, like the conventional loans we talked about earlier, they might not be acceptable for that, or they might have some issues that we can't overcome, where using an alternative source to finance it maybe can make it a lot easier. And then people
Well,
can either,
you said a
yeah, go
lot
ahead.
right there, Alex. So let's backtrack 1 second. Let's one step up.
Sure.
So you just said, because I know you said something about the conventional finance, and then obviously if the property, if it's a fixer upper, the conventional will probably be a little bit more easier, obviously, than the
Yeah.
FHA. And so did you by chance say that the DSCR loan would be even easier or more relaxing than the conventional?
It's 100%. Yeah. I mean, it's much simpler to do a DSCR loan than it would be a conventional loan. It's not always the right fit, but, for the people that it is the right fit, it's a great choice. But I mean,
Hmm.
what I would say, my opinion of that style of loan is, it's probably it's for somebody that's a little bit further on down the train of investment, and it's designed to make things simpler, but it's not necessarily where people start out at. It's not where I started out at. I think, utilizing some of the equity things we talked about in accessing that's really where people can get started a little bit sooner, and then maybe utilize some of these more alternative products once they're more established. So that's kind of what I feel like it's a good
So for
piece of work.
So what do you have to say for those out there that, they want to get into the investment game? They don't know where to start, how to start, and, they do want to build an investment portfolio. What would you suggest to them?
Yeah, I think there's always going to be the people out there that either save a ton of money or maybe get an inheritance or something. But let's remove those for the sake of argument, because it wasn't me, and it's probably not a lot of us. But the
Right.
people that want to get started and just sort of use real estate to leverage itself. I think the starting place for most people is buying a primary residence. I think without sort of the established roots that a primary residence gives you, it's hard to really leverage and expand in investment real estate. So I would say that's the first place. So if somebody doesn't own anything yet and they want to start down the path, probably buying their own primary residence is a good place to start. One of the things that I love about doing that, and it's not always easy to do, but I personally like to find fixer upper properties that I can live in, get it for a cheaper price, and really put a lot of sweat equity into it, and repair it, improve it, update it to current standards. And then what they can do then is have it reappraised or revalued. So let's do an example. So if somebody maybe wants to buy a property for $250, okay, I mean, those are rare, but like, let's say it's a $250,000 house, and the reason it's $250 is because it's got a lot of problems, right? It's got a lot of cosmetic issues. It doesn't have anything major, but it needs to be painted, needs a new kitchen, needs new bathrooms, all that, right? Somebody could buy it for $250 and then do a bunch of that work, right? So they could replace the flooring, they could replace the cabinets, the counters, really, make it updated to current levels. And to be honest, I wouldn't be shocked if that property was worth upwards of 400,000 when they were done. But if we talk about the actual investment of it, okay, you invested $250 to buy it, and
Hmm.
you might have put 50 into it to do all that work, depending on if you're paying contractors or you're doing a lot of the work yourself. And now so your total investment might be 300 in this example, but the property's worth 400, right? So you've just created that 100,000 in equity, not out of thin air exactly, but almost, right? Of like just buying something that needs work. It's not up to market standards, and improving it yourself, and then reappraising it and seeing that growth. So let's say then they have that 100,000, right? The next step for me, and for most people, would then be, all right, let's access that equity and let's take some of that money out and let's use it either to buy another primary residence if it's been a few years. Primary residences you want to plan on living for in at least for 1 year. Okay. So maybe if somebody wants to do it several houses they're living in first, that's fine. But then they can also keep that home, access the equity, and use that money then to buy their first rental property. So I think that's my favorite sort of default blueprint for how somebody can get started, is like buy a property for a primary residence that needs a lot of work, but it's okay. It's nothing major. It just needs to be updated. Fix it up, improve it, increase the value, and then use that value to then leverage on the next one and the next one. And that's really where I think people grow.
So just to put a timetable on this, Alec,
Yep.
they buy their first property. They live there for 1 year because that's you have to meet the minimum requirement for
Right.
owner.
Right.
After the first year, then they can then go turn around, do a refi, pull the equity out, and then they can go, or they can get a HELOC or anything else that's going to pull the equity out, and then
Yep.
they can turn around and then go and do a DSCR loan to buy the second property. So they can buy potentially two properties in 2 years.
Yeah, I mean, if they like say they wanted to buy, several properties all in, they have like a 5-year plan, something like that, right? Yeah, I mean, they could buy their first primary residence, fix it up for a year or two, sell it, and buy a new one, or they could even keep that one, and after a year they could rent it out, access some of the equity potentially, and then move on to another primary residence. So they could do it in reverse too, where instead of buying rental properties, they're buying properties for themselves to live in for at least a year or two, and then they could, upgrade in favor of themselves, but keep it instead of selling it and rent out the one they just left. So there's a variety of really options and paths that people can take. And I love it because it just gives us so much flexibility to be able to do a lot of the things that people are thinking about doing. And the thing about investment real estate, there's so many different things that people want to do and can do. It's not a cookie cutter thing, I mean, there's a variety of investment opportunities. I like, that particular style, and I like more single family or multifamily. But some people are big into commercial. Some people are big into, um, you know, big investments where they're doing sort of like percentage shares. There's a lot of different things.
And so, I mean, you probably kind of touched on it, but we didn't, make it an actual topic,
Yeah.
uh, because it's kind of almost going to the bird strategy. Because when you were saying like obviously you can buy one, you know, fix it up, then
Yeah, BRRRR is a common acronym that people will see, especially when they're talking about investment properties.
mhm,
It's BRRR. I think it's three R's. It stands for buy, renovate, rent, refinance, repeat. So actually, maybe there's four R's. But basically, what it is it means acquire the property, so buy it, right? Buy something that needs work, something that's distressed in some way, but that you have a vision or you have the ability to fix.
all right,
Renovate it, right? So fix it up, improve it, get it back to a clean bill of health and get it up to current market standards. Rent it. So now, if rental property is something that you want to acquire and you don't want to sell it, now it's time to put a tenant in there and get it rented. Once that is all taken place, now you can refinance. And typically, you'll be able to refinance and pull either all or most of the entire initial investment out. Because again, going back to our 300, 400 example from earlier,
right,
a lot of times the property value will be much higher than when you originally acquired it. Now you can get almost all of your investment back, still cash flow because you got the tenant in there, and refinance and get that new loan to access that. Now you've got your investment back and you can repeat as the last R and buy the next one. So as you see that BRRRR, all it really is a sort of a path or a way for people to continually acquire properties by focusing on properties that are distressed in some fashion, fixing them or bring value to the community, and then repeating that process and getting and having sort of a revolving door of money going out, but also money coming back in. And that's
right.
what keeps that train moving. Otherwise, if you're just saving money to acquire a rental property, it can take a while, right? And it's really difficult to outsave inflation and outsave appreciation for properties. It's easier to just create value in the marketplace by doing that.
Yeah, I think you probably brought up another good point too, because a lot of times people think that they got to save all of this money to be able to buy, properties. And so if you was to get your first, or if you're living in your first house or you need to buy your first house, that's a great way to have a built-in, I guess, investment that will be able to grow in
Yeah,
time. You keep it for a few years, and all of a sudden now you got equity built in, and then now you can, we can do some of the things that we're referring to. And
for
so,
sure. Yeah. Yep.
Alec, I know that you're not a tax advisor over here, um, but when you start getting these rental properties, I think people need to understand like the level of tax savings that they possibly get out of this thing. What you got to
What
say to
I'll
that?
say, yeah, I mean, I'm not a tax advice. This is not a tax advice, but I just give you some touch points. Long story short, investment real estate opens the door for a lot of tax benefits that people can evaluate with their CPA. And that can range from, being able to depreciate a rental property and reducing your income a little bit, up to a topic called cost segregation, where they can really take a big deduction in the first year of owning a new property. I'm not going to get into the details of that. Just know that there are a lot of tax benefits to it that really can compound on each other.
Hmm.
And if that's something that somebody wanted to know more about, I would recommend either asking us maybe offline, and we can give a little bit more detail to it, and then also talking to a tax advisor or a CPA and asking some of those questions as well. But yeah, I mean, there's a ton of tax benefits if that's something that is the right fit for somebody, you know.
And I think that this is definitely key for folks that is maybe high income earners, or business owners that they need to start sheltering some of their funds, things of that. People that's probably got more of a tax problem, they can definitely offset it when from buying these investment
Well, yeah, I
properties.
mean, unfortunately, these days, like we all need some benefit from the tax man, right? I mean, it's whether you're high income or not. I think there's benefits there for sure. You don't have to be a high earner to be able to benefit from it. You could
Right.
be, you know, a blue collar family and still really benefit from this. So I think there's a lot of ways that people can utilize some of the rules out there to their advantage and really help to grow their family's wealth, because ultimately that's what it's all about for me and for you, I think, and for a lot of the people kind of watching or listening, is just kind of growing up your family's wealth, creating a legacy, making things, you know, better for the community, better for you. That's at least my path.
And so, with the question, uh, a lot of times people be thinking that this can take years and years and years to accomplish. How long does it take to build wealth in an investment state?
Yeah, I mean, I think there's two parts to that question. One, building wealth, at least in my opinion, is sort of a long game, right? It's not, you're not going to build a ton of wealth overnight. So I think you got to have the right mindset going in. You're not going to be a millionaire by doing this in a year or two, but starting down a path and then watching it grow over the course of time, even in a short period of time. It doesn't have to take 30 years or, until retirement. It could be a 5-year period, but you'd be surprised if you watch things grow and you're doing the right things, how quickly it can grow. But then there's also ways, like we sort of talked about today, is there's ways to make it faster. There's ways to sort of um, cut the line or leverage certain things to shave off time and really allow your wealth to grow quicker and better. So I think there's an element to that as well.
Right. And I think that, for the folks that's going to be listening to this, um, we all have to start somewhere. And obviously, if you are a person that don't own any real estate, the first biggest thing is just getting you some real estate.
Yeah,
And are a person that owns a place, for a lot of these people, they don't want to leave their house. It could be because, the interest rates are higher, or it can be because property values have increased and maybe they got outsourced. I mean, starting to build up your investment portfolio will offset some of the future things that you want to do if you are looking to, yeah, or if you need a bigger house and you look at the bigger houses and they might be out of the price range, maybe you go get you an investment property to try to offset some of that. So
yeah,
then when you get, at least you have something, that you can use as leverage, or you can use to be able to help, make the payments a little bit easier to make. And so, Alec, do you have anything else that you want to add to this?
no, I think kind of in closing thoughts is investment real estate can seem daunting or can seem really complicated. And don't get me wrong, there are elements to it that are, but it's sort of just a step by step process and uh, you know path that somebody can follow. It's not rocket science. I mean, I'm for me, I need to keep things simple. I mean, there's just with families and everything else, there's too much going on to really get into the super complicated stuff. It's just about, creating a plan and walking down it. I know that you are, and I'm here. If people have questions and want help figuring out that plan, we'd love to help them. But I think, yeah, it's not as complicated as maybe people think. Once they get into it and realize some of the steps it takes, it's doable for sure.
Right. No, absolutely, absolutely. And so, um, I guess the first thing that I guess the call to action that we should take is if y'all guys looking to get y'all first property, you obviously can reach out to myself or Alec, and we can help you start the journey. We can definitely paint you a blueprint if that's what you want to do. Is get into the investment game. We'll show you how all of that stuff will work. And obviously, if you want to do this over the next, year, 2, 3, 4, 5 years, we can help you get as big of a portfolio if you want, as you want, or you can have this, maybe just have a property that you have and, for retirement or something else. And so we definitely appreciate you guys listening, and we definitely catch you on the next live. Thanks, Alec.
Yeah.
Appreciate
Thanks for having me. Yeah, it was fun.
it. All right, guys. See you later.
See you guys.